Good day, welcome to our International Finance Markets and Institution lecture. Okay, so today we're going to be talking about the term structure of interest rates. Okay, let's start by defining what it is. So it is the relationship between the term to maturity and the yield to maturity. So most of our investors, they prefer securities which are liquid. It means that they should be able to be converted easily to cash without any loss of value in those investments. So if we want to give our investors long-term securities, it means that we have to give them a higher yield in order to attract them, because many investors, they prefer liquidity. So if we want them to invest in our long-term ones, if we want to lock them into our long-term investments, we have to give them a higher yield so as to attract them. Okay, let us look at the type of yield curves that we have. I have three types here with me. The first one is a rising yield curve. So this one is formed when yields on the short term issues are low. So our yields on short term, they are low, and they then rise consistently with the larger maturities. Then the second one, a declining yield curve, is formed when the yields on short term are high. So our yields on the short term are high, and yields on subsequently longer maturities are declining consistently. Then the third one, a flat curve has approximately equal yields on short-term and long-term issues. So we are going to look at our theories of the term structures. There are three theories which we are going to look at. So the first one is the pure expectations theory. Okay, so the pure expectations theory states that forward rates are unbiased estimates of future interest rates, or that forward rates are equal to expected future spot rates. Okay, so with this one, the pure expectations, it is determined solely by the expectations of the future interest rates. So we may be expecting that the future interest rates are going to go up, or they are going to decrease. So let us start with the first assumption, where we assume that the interest rates will rise. So if the investors assume that the interest rates are going to rise in the future, what they're going to do now, they're going to invest their monies in the short term. When they invest their monies in the short term, it is a shorter maturity period. When it matures, then they get the money, their principal, and then they reinvest them into the higher yields after the interest rates have increased. So what it means is that many people will want to gain when the interest rates increases again. So many people will invest in the short term, which results in the flooding of the short term securities market. So when it is flooded, it means that the yield for the short term will go down, and then the long term yields will go up again. So that is what will happen if we assume that the interest rates will rise in the future. So for now, our short-term yields will go down, but the investors, even if it goes down, they do not care about that, because they will reinvest their funds at a higher rate. Okay, so what happens if we are expecting that our interest rates will decrease in the future? So as you know, with our bonds, the coupon rate doesn't change. So investors will prefer to invest in long-term funds. Why do they prefer to invest in the long-term funds? Because they know that they will lock their investments using today's rates. Even if they decrease in the future, it is not going to affect their investment. Okay, so let us go to the second theory, liquid premium theory. Okay, so it's liquidity premium theory. So with this theory, it is assumed that many investors prefer to own short-term rather than long-term securities, because with the short-term securities there is greater liquidity. We are able to easily convert our securities into cash, and we do not lose a lot of value in our security. However, they will be willing to hold those long-term securities, although they are less liquid, because they want to be compensated by a premium. So in order for us to attract the investors to invest in less liquid or long-term securities, we have to compensate them by giving them a premium, to give them a higher yield so that we attract the investors. So with the liquidity premium theory, our investors are only concerned with the liquidity of their investments. So they normally go for short term because it is liquid. If we want them to come for our long term, we have to offer them a higher yield. Then they will be willing to move over to the long term securities. Then let us go to the third one, the market segmentation theory. This one says the ETF that exists at any time reflects the actions and preferences of major participants in the bond market. These major participants have preferred maturity ranges, but attractive yields in different maturities lead these participants to accept maturities outside the preferred range. So here we have got different investors and borrowers. So they choose the securities with maturities that satisfy their forecast cash needs. For example, the pension companies and the insurance companies, they may prefer long-term investments. We know that the pension companies, they pay out after someone retires, so they want the cash maybe after a long time. So these people, they want to invest in long-term securities so as to cater for their long-term liabilities. They will pay after some time. It's different maybe from a commercial bank. They want to invest so that they will cater for their liabilities maybe 3 months or 5 months down the line. So investors and borrowers here will choose the securities which matures according to their forecasted cash needs. Okay, so that's it for our term structure of the interest rates. Okay, then we are moving on to the central banking and monetary policy impact. Okay, so the Central Bank of Botswana is the responsibility of conducting national monetary policy. This policy influences interest rates and other economic variables that determines the prices of securities. So what they do, central banks, they play around with the money supply. If they want the money supply or the interest to go up or down, they will play around with the money supply. So central bank, it uses an open market operation, that is buying and selling of securities, as a means of adjusting money supply. So if they want to increase the money supply in the market, they just purchase the securities. And if they want to reduce the money supply, they will sell the securities. Okay, so when they do that, it will also influence the aggregate demand and supply in the economy. Again, borrowing, spending, it will be dependent on the level of money supply in the economy. Okay? If the economy is weak, the central bank can increase the level of spending as a means of stimulating the economy. It uses open market operations to increase the money supply, a move that is intended to reduce interest rates and encouraging more borrowing and spending. Okay, so this can be done by purchasing securities. So investors who sells their securities to the treasury receives the payments from the central bank, and there will be a increase in the money supply in the economy, which will result in the increase in supply of our loanable funds. I think you still remember our loanable fund from the previous lecture outcomes. So if the supply for our loanable funds increases, it means our interest rates will be reduced. Again, because many people will be having the money. Okay, then on the other hand, if excessive inflation is the main concern to the central bank, they can institute a tight monetary policy to reduce money supply growth. We know that inflation is when too much money is stressing to feel good. So we want to reduce the money supply. So how can we reduce the money supply? So we can reduce the central bank can reduce the money supply by selling some of its holdings. So central bank, they sell their securities and investors make payments to purchase the securities. Thereby, they will be reducing the money supply in the market. So when they reduce the money supply, it will result in the increased interest rates, because many people will be looking for the money, but it will not be, the money supply won't be too much in the economy, thereby pushing the interest rates up. So the central bank has to keep a balance between inflation and unemployment. They might be fighting inflation by reducing the money supply in the economy, but it might result in unemployment. So it should have a balance between unemployment and inflation. So they should look at the benefits to the economy as a whole. Okay, it's the impact of monetary policy on the financial market. So we said the central bank, it will be impacting the economy by money supply. They might increase the money supply or they might reduce the money supply. When they increase or reduce, it will also affect the interest rates. So on financial markets, remember we said there is an inverse relationship between bonds and the interest rates. So when the interest rates, when they reduce, when the central bank, when they reduce the interest rates, it means that the price of the bonds will go up. When the interest rates are increased, it means the prices of the bonds will go down. So that's the impact on our financial market, because we have an inverse relationship between the bonds and the interest rates. Okay, let us go to the next one, global financial market. Okay, now the world is now a global market. If I want something in USA, I can get it. If I want to invest in another country, in South Africa, in UK, in the US, or wherever, I can do. It's now a global market, especially with this internet thing. So we can access anything anywhere. So if we want extra funds, we can go global and get the resources we need from people of other countries. So we have the debt market where we sell our bonds, the treasury bills. Okay, so in recent years, financial institutions such as pension funds and commercial have commonly purchased foreign bonds. So yeah, people may be having their surpluses there in the foreign net, and we can utilize that if we need. Maybe we can't find anything in our home country, so we can go international, purchase the bonds from people from other countries. Or maybe in their countries they are not offering them high yields, and us as a country we are offering high yields, so they will choose our bonds over bonds of the other countries. Okay, then we go on to the equity market. We know that equity market, it is stock market, share market. You want to buy shares, you want to be part owners of the business. So now, even if you are in Botswana, you can be a part owner of a business which is not in Botswana. So it is now easy to tap into the foreign market. It is now easy to be part owner. It is now easy to purchase foreign stock because the barriers have been minimized and some have been removed. Although some of the countries they want to protect their citizens, but I think let's say minimized. Okay, then foreign exchange market. This is where we change our monies. Usually, actually, we want to transact with people from other countries, so we have to use their currency. So we'll be changing from our currency to their currency. So we use the banks, yeah, the other financial institutions too, to exchange the monies. We want to exchange one currency for the other, and it is determined by the exchange rate prevailing on a particular date, because we know that the exchange rate they respond to supply and demand, so they may go up or go down depending on the demand and supply. Then we have the primary market. I'm sure we all know the primary market. We covered this in LO1. Okay, so the primary market, it facilitates the issuance of new shares. So if a company wants to issue new shares, they will go to the primary market. We also call it the IPO, initial placement. Then we go to the secondary market. So this one, it facilitates the trading of existing securities. So it's the shareholders, you want to sell your shares to someone, it is done through the secondary market. So here in Botswana, we've got the Botswana Stock Exchange, where we can sell our securities, bonds, shares. They can be sold in the secondary market. However, it is important to note that for us to issue our shares in the primary market, our secondary market should be functional, because if a person no longer wants the shares, they will be able to sell. So if maybe we are issuing our new shares in the primary market and the secondary market is effective, it might be difficult for us to get the investors who want to get our securities, because they will know that if they purchase them and the secondary market is not effective, they will be stuck with the securities forever. So it is important to have a effective secondary market. Okay, then we have the money markets. These ones are the market for those short-term marketable and highly liquid, maybe those treasury bills, certificate of deposits. Yeah, it is also called cash and cash equivalents. It is easily convertible to cash. Then we go to the capital market. I'm sure we remember the capital market. It is the market for longer term and relatively riskier securities. For example, bonds, equity, and derivatives. Okay, so that's it for our LO6. Okay, let us go to the last LO, the major financial institutions. So the first one, we have the commercial bank. So commercial bank, they offer a wide variety of different deposit accounts. So what we do is you have surplus, maybe as individual or as institutions who go and make a deposit into the bank, and they transfer those deposited funds to other units which needs the money. For example, there are people or institutions which are in need of loans, so they will take those deposits and they will transfer them to provide the loans, or they can invest their monies. Okay, so the commercial bank, they into lending and borrowing, and that is how they make profits. If you borrow from the bank, if you borrow, they are lending you again. So if they are lending you, you have to pay interest. That is how they make money. And they also pay an interest to those who are depositing to them, but they pay a lower one to those who are depositing to them, so that they will be left with a profit. Okay, let's go to the next one, an investment bank. Okay, investment banks are also banks that arrange specialist financial services like mergers, acquisitions, funding. Their activities include giving financial advice to companies and arranging finance. So these ones, they are not for the general public. They are usually for companies. They want funding, they want to fund, they assist in mergers. Maybe they want to have takeovers. So the investment bank will be helping with all those activities to the institutions. Then we go to the pension funds. The last one is the pension funds. So pension funds they accumulate funds to meet the future pension liabilities of a particular organization to its employees. Okay, so employees and employers, they will be making contributions to the fund, and after retirement, that is when they get their funds back. So the money is managed by the pension funds until the individuals withdraws the funds from their retirement accounts. That is when they retire. So these pension funds, they will be making investments on behalf of the pensioners. Then we go to the last one, which is private equity firm. Private equity firm are typically limited partnership where institutional investors make a commitment